Welcome, everybody, to another episode of the Business Barbershop Podcast. I am Chris.
I'm Keen.
And we are live in studio, a.k.a. my conference room, to talk about rates, I believe. So it is June 3rd, 2025, at the time of this recording. The year is almost halfway over. And Keen thinks he has stumbled upon some information that's going to change the world. So we're going to have a prediction show here and see what's happening. I don't know exactly what we're talking about, so I'm excited to learn as well. So, Keen.
Yeah.
Take it over.
Yeah. So, when interest rates first went up, everyone kind of tried to do their own prediction of how long the rates stay up before they go down. And there's a number of things that are happening that impact rates, but for the most part, rates do stay high when inflation stays high. And they aren't always tethered to things like short-term rates, but lately they have been.
And that's one thing, though, that they talk about a lot. They do quarterly rate decisions?
Monthly.
Okay, so every month, basically, and every month, they have these rate things. They often talk about inflation when they're talking about their decision-making process.
Yeah.
Right?
Yeah, the Fed has two mandates. Their job is to try to control inflation, but also try to make sure they prop up and protect the job market.
Right.
And so, and it's a blunt tool, but holding short-term rates high to get inflation under control has historically worked. And, the Fed wanted to try to get to like a 2% inflation. They haven't quite gotten there, but they effectively took it from 9 down to 3/4, and I think it's been right around 3% lately.
Yep. There's a downside too. If they cut too deep, then the economy gets affected.
Yeah, they could force a recession. Mm-hmm.
So you're sort of looking at job growth, maybe, or some sort of job numbers in
Yeah.
inflation, and you're trying to sort of thread the needle.
That's correct. And that's the tough job that they've had. I mean, I know that people like President Trump wants to throw Jerome Powell under the bus and say he's done a horrible job, but I actually think that all up to recent times, I don't really disagree a lot with his decision making. I understand from both points of view. Do I think that he could cut a little sooner? Potentially, but I think that most people in my industry have wanted him to cut sooner because we obviously do a lot more business when rates are lower.
Right.
I'm trying to look at it in from a global point of view and understand the mandates. And
right.
With stubbornly strong job reports and strong consumer confidence, it's hard. And a lot of that's being propped up from markets rallying, the growth of AI. And so these are all things that are propping up, one side of the market. And so I've had a really hard time trying to predict that rates would come down rapidly. And I've kind of, for the most part, have forecasted a very, very slow slide. Like this year has been mostly sideways. People say, well, that doesn't sound like a slide. I'm like, yes, but the peak was 8 and rates are right around 8 to 7. And so, and the peak was in the fall of 23. And so that to me is a very slow slide.
Those rates are mortgage rates, though, right?
Yeah,
so
that's correct.
They're tied to not just this short-term interest rate.
Long-term bonds get more. They do a little further forecasting, and so anything that's inflation-related has a bigger impact to long-term rates.
Yeah.
Because of the long-term hedge.
What's crazy though is like in the 6s is not historically a really terrible number for a mortgage.
No, it's not. But affordability is a function of two things. It's the rates and the cost of the housing. And so housing is at record level highs. Like the cost of the rates and the prices together make it the most expensive time.
Yes.
For owning housing, which is one of the reasons why my business plan is so built off of helping people build wealth in real estate. Because, people ask me my honest opinion about buying real estate. I'm like, if you're going to just buy a house for you to live in, like you've always argued that, owning a house is just liability. When rates are 2 to 3%.
Whoa. I've not said that it's a liability. That's not what I said.
It's just not an investment.
That's right. It's not the best place to put your money if you want it to grow. That's all I said. It is there are benefits to owning a home, but to say like it's going to be my investment tool or whatever, I just think is sort of
flawed thinking.
Incorrect.
Yeah.
There are other things that you could do. That's all. There are other definite benefits that are non-monetary with owning a home as well. I just don't think when people say like it's like the best long-term investment you're going to make, blah, blah, blah. I just don't think that's
Yeah.
totally true.
Yeah, I think the reason why it has been a great investment tool for a lot of people is because you get this multiplier on your growth because you get this growth on leverage plus a tax shelter. And so when you get strong appreciation, especially when rates were lower, you get this leveraged growth of equity, which could be substantial. But to your argument, it's not always going to grow that way, and rates aren't always going to be that low. And with what you've said in the past, compared to what the market looks like now, with rates being higher and slower appreciation, housing market's been going about 3 to 4%. This year's projected at around 3%. Last year was around 4% of annual growth. That's on leverage. That's not that you get if you're putting 10% down, you get a 10 times multiplier on it. So there's that. So that's why they get such a high rate of return on it. But they have to service the thing is the problem is they have to service the debt.
Correct.
And that's an expense of the homeowner to do it.
Maintenance. Mm-hmm. There's other property taxes, which are great. Depends on where you live. They could be pretty high though.
Right.
And the other thing too is if you lived, back in the let's say like even the 70s, even the 80s maybe, a lot of people bought their homes and they just stayed there forever.
Yeah.
Well, if you do that, then it's actually not bad because you do you get on the other side of your, payment schedule.
Right.
Where you actually do start paying down some principal. You do get a lot of appreciation, so you don't just have, these what I would call maybe leaner years. You also have those big spikes, and you can pull that equity out. That's the other thing too about like everybody's like, oh, I'm saving for the future, but if you look at your mortgage schedule, you're not actually paying towards your principal a lot for about the first half of the loan.
Depends on the rate, rate and term. I mean, when rates are really low, a lot goes to principal, and so I would argue that
not at the beginning though.
Oh yeah,
they're front loaded. Okay, what's a lot?
Okay, so I'll give you an example. You remember the graph for the interest you pay over a loan and the principal you pay, if you overlap them, looks like a kind of rounded X. It's not a flat line.
They flow in opposite directions.
That's correct.
Really.
But even if the term is longer, the lower the interest rate it is, the flatter the X looks. And so I'll give you an example. My first rental project I took was a 3-unit in Alki that I chopped up into condos and then refinanced it. And I paid exorbitant discount points when rates were already at record lows to push them down to 2.25% for a 30-year fixed. And 2.25% and rates typically get sold in eighths of a rate. So go 2.25%, 2.375, 2.5, 2.65. So they typically, most mortgage bankers offer it in eighths of adjustment. So 2.25% was a very special interest rate for me to buy it down to because A, it was possible to do. And B, that is the first interest rate in eighths where the rate is so low that your very first payment more than half is principal, and then it only accelerates every month after that.
Okay, so you're telling me right now about the one single outlier that you can find at a 2.5% interest rate.
2.25 is
2.25% interest rate.
But anything that's close to that, you only have to be into it for about 4 or 5 years before you hit the halfway, before you go to half. But on current interest rates, it's very much the way you described it.
10 years, 12 years at least, right?
Oh yeah, it takes at current interest rates, it takes more than 15 years before you get to the half where half goes towards principal.
Yeah. Mm-hmm. So anyway, I didn't mean to like digress off of that, but
be careful with me. I geek out on this stuff.
I like it too. Look, I like talking about this stuff. I think it's also, if people are willing to listen, like I don't think buying a home to live in is a bad idea. I just want people to do it with the understanding of what it is and what it isn't.
Yeah.
Is that, you know what I'm saying? Like, if you want to own a home, that's fine. Like, that's great.
I could break it down very pragmatically, probably time for a different show of what's good and bad with it. But there are people who end up leaning on it too much as being like their primary form of wealth, which it does for a lot of people. And I don't disagree that people should look at it at a different point of angle, but like if it actually bodes to the argument of what I try to propose people to do. If you really love the fact that your house has represented a big part of your wealth, the problem with that is that you always have to service the debt. Yes, you get tax sections as the place you live, but you still have to service it.
Yeah.
So of all the factors that play into why real estate has helped you build wealth, you're buying in a good neighborhood, it grows on leverage, plus there's tax shelters. But the problem is that you're the one who has to personally service the debt. my answer is like, well, why the hell would you not buy rental properties then? Because you get all the same things we just talked about, and then the tenants pay for it. So you're not servicing the debt; they are.
I agree.
Right?
That's what I do. That's why I own real estate. I just don't own a personal residence.
Right.
I'll tell you the other thing too that does make a little bit of a difference for me specifically, just to like full disclosure. You know, like I live in one of the most expensive cities around.
Yeah.
So I just also don't want to fork over a lot of money as a down payment.
Not to mention that the cap rates are horrible.
That's right.
So the gap between owning and living here is very far apart.
And so I can actually rent here a really, really nice house.
Yep.
Literally the dishwasher broke and there's somebody over there today fixing it. And it's not on me at all. You know what I'm saying?
Yeah.
And I actually my rent is probably about 2/3 of what like the mortgage payment would be, and probably even less than that.
I think it's less than that.
Probably even less than that. So it's like for me, it's a win. You know, plus I have 5 kids, so like
I think the easy answer is
condo.
if there's a moment in time where you can own your own house for close to the cost of renting it, and you get the tax benefits and equity growth to go with it, then jump on it. So my answer about homeownership is not a static one.
Yeah.
It's very much market conditioned.
But what I did do though was, I don't own a house that I live in, but I have
rentals,
3 units basically.
Yeah.
That I put a fraction of what I would have put into a down payment. That cash flow every month.
That's right.
That, like you talked about, I get to depreciate.
Right.
You know, I get to write off any sort of maintenance and stuff like that. So there's just like, it's kind of for me, not a big deal to say that I rent a house,
Yeah.
Plus, real talk, it's kind of fun to move. I like to move every once in a while.
Yeah.
Basically every year I get to go look around and see what's listed and go like, oh, is there a fatty on the market?
Especially
go.
if the kid I mean, imagine what that lifestyle looks like when it gets to the point where the kids get older and it's just you and Brooke. Then
I mean, we're not moving this year. We're staying this year. But I moved like 3 or 4 years in a row. Prior to that, and just because, you're in a place, you just look around and you're like, rents have actually gone down a little bit since in that time.
Yep.
Just because I don't know, just because I don't know why, but and
there's a little spike with rates. Right, the job market was still strong, and the housing market when it got expensive, so the rent rates went up a little bit, and then they've come down a little bit.
Well, the economy hasn't. I wouldn't say has cooled here or anything, but there are definitely there's less, I think, slushy money out there.
Yeah.
Like in the tech
Yeah.
sector.
Yeah, there's some layoffs in tech, and then now the adjustments with AI. Mm-hmm.
People that are working are still making a tremendous amount of money around here.
Right.
But it's just not as frothy, I don't think, as it was.
Which probably is a good thing.
Yeah. Yep.
So
again, let's get back.
You get back to all of it. Like if you said, okay, well, if the job markets are stubbornly strong, consumer confidence is high, but inflation is also still high. You could argue that we get stuck in this kind of stagflation place where we got to just keep rates high for a while, and it's painful but necessary.
Yep.
And that would predict a slow slide. And I think that for the most part, all the moves the Fed have done have been kind of pointing to that they're threading that needle like you talked about. And that for the most part didn't really forecast any dramatic thing that would push one way or the other.
Yep.
Right.
Well, it's been easy for them to do because they haven't seen any dip in the job market, right?
Yep.
So there's no the what you're worried about by keeping the rates on the higher end is not happening.
Right.
So you don't really have a lot of motivation to push them down, except for everybody crying that the rates are still high. But they're like, look, the rates are high, but look, everything is still peachy over here.
That's exactly their position.
Yeah.
And so now there's been 2 big factors that have been brewing for the last couple of 2 years that would point that they need to address rates.
Okay.
Because if the problem with black swan events is that sometimes you don't realize how big they are until they hit. So let's take the subprime
you really
meltdown.
Almost never do.
Right. And so let's take the subprime meltdown, for instance.
Yep.
Okay.
Absolutely.
Leading until 2007, 2003 to 2006 were, gangbuster years in the stock market and real estate. And so, but there was obviously a systemic issue with the way we're giving loans that caused a systemic failure in the housing market, and that literally tanked every industry and the equity markets to the point where major bailout money was needed, right?
Yes.
So there's two things first that have been brewing that are starting to become very high pressure, that even though we haven't seen it in the job market yet, if the Fed doesn't address it, could be a very problematic thing. One is the government has its own $9.2 trillion worth of debt they need to refinance this year. Correct. And if they do it at interest rates, it will accelerate the rate that they'll end up having to default on those payments themselves.
100%. That's why Trump is pissed.
That's why Trump is pissed.
Like, it's pretty much like the only reason.
That is definitely something that could cause a black swan event.
Yes.
The other one is that they've been quietly not talking, like people in the industry have been talking since, really the beginning of last year about commercial property defaults.
Yep.
But people don't know about commercial properties is that it's the subprime features in residential loans are very normal in commercial loans. Adjustable rate mortgages, long prepayment penalties.
Just what? Would you say
Adjustable rate mortgages. Adjustable rate mortgages.
Yep.
Prepayment penalties, where if you refinance or sell before a period of time, you get penalized. Mm-hmm. And balloon loan payments. Balloon loan payments are where we might make payments on it like it's a 25-year loan, but actually the loan's due in 5, 7, or 10 years.
Got it.
So there's this giant principal balance due at that period. Right. So these properties get evaluated based off their cash flow, which also is based off the interest rates.
Right.
So if you take these properties and said, okay, these things cash flow great at this interest rate, and then people buy those properties at the market rate, maybe they put 40% down. And then all of a sudden, there's a hybrid of work from home.
Right.
Office vacancies go up, incomes drop.
Right.
Then also interest rates have increased, and now those loans become due. The properties are worth substantially less than they used to be. The owners who had sunk millions and millions of dollars in down payments have lost all their equity, and they're being told that the only way they could refinance it is to basically make a gigantic other principal contribution to it, so that way it meets their debt service requirements at the current interest rates, and they don't have the money. Right. Commercial loan properties right now have reached a default rate of over 5%, and it's growing. So there is quietly a commercial property subprime meltdown starting to begin.
Okay, so you think that? Do you think that is going to be one of the indicators of this black swan? Is that number 2 or number?
That's number 2.
Okay, what was number 1 again? Refresh
the federal debt that needs to be refinanced.
Got it. Okay, yes.
Okay.
All right. Okay.
So both those things have been brewing. Mm-hmm. So that's the pressure of like, hey, could these two things put us into a black swan recession where all this hunky-dory consumer confidence that everyone has and strong job markets gets decimated like it did in 2006 going into 2007 and 8, right? Mm-hmm. Maybe, maybe not. The third piece is that the bond market has become completely broken in terms of the buyers for bonds.
Because of number 1, right?
No, not necessarily.
Not really?
No. It's actually because of trade wars. Okay. So the biggest purchaser of U.S. debts has traditionally been other governments.
Right, like Japan. I know I don't know the details, but there was
the Middle East, China, right? They would buy our bonds, right?
Yep.
The confidence in the dollar. So the dollar has been weakening with all the trade wars, and the countries that we're having trade war negotiations with have stopped buying our bonds.
Correct.
And so there's been times where the bond market has been broken before. Normally, there's a tether between the buyers of mortgage bonds and the stock market, because traditionally the bonds have been considered a flight of safety.
Right.
So when the stock markets aren't doing great, people will buy bonds.
Right.
The yields for the bonds drop because the demand's increased, and people still buy it because it protects their losses. So it's usually considered a flight for safety.
And the way it works is, I think every month, like the Treasury holds an auction or sale essentially for these bonds.
That's
and it's
correct.
Like a certain amount of bonds or whatever, like money debt that they're trying to finance, I guess, or whatever, and people come and buy them. But I don't know actually much of the details. You may know more about it, but I think like the last one, like hardly anybody showed up.
Oh yeah,
right?
That's what I'm leading to. That's what I'm leading to.
All right.
So the buyer of bonds, usually there's a flight for safety where there's a lever that connects between stocks and bonds. And the last time, that lever was very badly broken for mortgage bonds in 2007, because in 2007 people, fled their money into Treasury bonds, And we were expecting mortgage rates to come down with it because typically mortgage bonds will get traded very similar to the way T-bills do, right? One is backed by federal government. The other one's backed by U.S. real estate that's insured by the U.S. government. So there's a similarity between them.
Yeah.
T-bills are considered slightly safer, but they have lower yields. Mortgage bonds are considered slightly more riskier, but higher yields, right? But they would kind of move together. And the connection between those two kind of bonds were broken back in the subprime meltdown because obviously one was attached to real estate. Real estate was crashing. The federal government wasn't. And the Federal Reserve started something for the first time that was, which was very, monumentous, which was the beginning of quantitative easing. The Federal Reserve said, well, we need mortgage rates to drop, and you guys are only buying the T-bills, so we're going to just buy the mortgage bonds ourselves, which then triggered the stock market to say like, oh, well, we're worried about those bonds failing, but if you're going to buy them
And we're going to go
with the money that we're giving you to buy the T-bills, then we're going to buy them too. And then they got connected, and then rates came down. Okay, that was the beginning of trying to help save the housing market, which was a smart move.
Yep, it worked.
And the federal government has been trying to find a way to get off of, because they did quantitative easing all through 2008, all the way until close to 2020, right? And then they started to back off a little bit, and then COVID happened, and then they had to go right back in and do it again.
Right.
And so 2023 represented the first year they finally said, no more. We're done. You guys need to be a little bit more independent and stand on your feet. And they stopped buying the bonds. There were still buyers for it. Rates went up, but they're like, you guys can handle it. But the bond markets have been broken now, again, because of the trade wars. And you're correct. The last Treasury auction, there were more bonds for sale than total buyers. And for the first time since quantitative easing, the Fed has begun buying bonds again. Now, they didn't do it by a huge amount.
Yeah.
It was about $20 billion, but it's a slippery road to be on, right? They're like, we're not buying them anymore. You guys got to stand on your own 2 feet.
Yeah.
And all of a sudden it's like, oh, unless no one shows up.
Right.
Right? And so now if you take all those pieces and put them together and say, okay, we have only a handful of months before $9.2 trillion in debt needs to be refinanced. We have over 5% default rate in commercial properties and getting worse. And also the bond market no longer has its buyers anymore. And the Federal Reserve has already had to buy some anyways. Gives us room for us to say, okay, if the other two things become a bigger issue and the Fed was holding tight, they didn't want to go back to buying bonds, but now they have to do it anyways, I can see a future where they're saying, okay, we get it. We can't let these two huge events blow up our market, and we already have to buy them anyways until these trade war stuff gets done anyways. So I can see how somewhere in the next 6 to 18 months, it will just become a little bit more normal for them to buy them. Mm-hmm. And then some of the trade war stuff will settle down, and then rates will come back down. I think for the first time, I could see enough factors where the Federal Reserve would have to step in the form of stimulus like quantitative easing, buy large amounts of bonds to push rates down so some of those debts can get refinanced, right? And the whole mandate of them trying to protect inflation is being offset by them also trying to protect the job market, which very easily could blow up if the other two things end up becoming a big issue. And so, this is the first time I would say that since rates have gone up, I actually could see a forecast with a deadline. I say 18 months. I really have a hard time predicting even going out that far. Yeah. But of course, there's a lot of events that can happen between here and there, and we really don't know exactly how the Fed's going to handle certain things. But there's a reason why. Because at one point, obviously Trump is like beating up Jerome Powell, but he anointed him to that position. Yeah. And he's a Republican. Mm-hmm. But I think he's needed to see something else that really says, hey, Trump, you own a lot of real estate. Who else was blowing up Jerome Powell? Grant Cardone was doing it on social media, saying he's done things terribly. I think that there's a little bit of like some drama associated with like attacking him, just because that's just a method to kind of get his attention. Yeah. But I think the reality is, I agree with them that he needs to step up now, but I don't think that he's done a terrible job up to this point. I think he just has to recognize that the music is going to stop in a couple of different ways, and you're going to have to buy these bonds anyways. So why not just fix all three at the same time? Reconnect the market to the bond market because you're a buyer in it. Let those trade wars kind of wrap themselves up. Get those debts refinanced. Help, the commercial properties should take some, just like the residential market did, but we do not need to let it become a systemic failure. I mean, I was talking to Andrew about it, and I want to say that there's one of the biggest holders of real estate in the Seattle area has 7 properties in receivership right now.
Yeah.
That's not a small deal.
Yeah, but that's kind of how it goes. Okay, here's my question. I like your analysis. Okay, let's take these one at a time.
Okay.
I'm going to be the foil to your argument a little bit, or just give you some of my ideas, like my counter punches to your things. Okay. So for number 1, what I've always heard is when you owe the bank $1 million, it's your problem. But when you owe the bank $1 trillion, it's their problem. Okay?
That's one way to look at it.
So this is typically a problem that gets worked out because there's really no option for it to not work.
But they have to. But there is someone reaching in, pulling levers to make that happen, and that lever very often looks like stimulus.
Yeah, but it could just be like a straight. I don't know enough about how the debt works.
Right.
It could literally though just be like we're just gonna reset this somehow. I don't know.
Right.
There's all kinds of weird things that can just happen.
The easiest way to do it is if there is a method that it can have a direct connection to controlling interest rates, which they do, and they've already done it before. They can lower rates enough through quantitative easing and stimulus to get it low enough so they can refinance the debt and prevent the default. So that way the payments are cheaper than the cost of the income coming from the GDP. Right.
Yeah. So I've also yes. There on the other flip side,
I think one of the standing arguments to that is if I'm going to argue against Trump's position to beat up Jerome Powell to drop interest rates, it's like, well, you're so excited to pass this big, beautiful tax bill that even Elon has come out saying that he doesn't totally agree with. Because after all the Doge cuts, it's cut so much revenue from the government, and we need some of that revenue to help service the debt payments that we're referencing.
Well, this would be like where the tariffs come in and some things of that nature.
Sure.
Right. Which would be the other argument, which is we're just going to have enough money that we're going to be able to just pay this debt down anyway and service it, in a way that, balances the
It's
budget.
moving some things in the right direction, some things against I like some of the things that are in the tax bill, but I wonder whether or not there had to be that many cuts.
Well, most of what the tax bill does is keep what's in place right now.
Yeah.
Like there's not a significant. I've heard many, many different opinions about this tax bill. One of the things that I've heard, which I'm not sure what is true and is not true, is that a lot of the rhetoric or the reporting or the analysis that you hear about the significant increase in taxes is it's based on the reset. So if you take the current tax structure and the exemptions that you get and things like that, and you pair that with the new tax bill, there's no increase. There's no decrease in tax revenue. What they're doing is saying if these all reset, here's what we would be, and we're jumping way up.
Right.
Does that make sense? So I don't know. I don't know if I think, whatever. I don't care about the tax cuts. But I think, however, that they're going to fix that debt problem. It's just going to fix itself.
But it's going to fix itself, but then you have to ask the question exactly how. And one of the most obvious ways is stimulus, lowers rates, refinance the debt, right?
That's hard to do, though, because then that jacks inflation up right away.
It can jack up inflation, but it also helps save the second factor.
So
this is the whole reason why I have not said I think the $9.2 trillion in debt is going to force rates to go lower.
Let's go to factor number 2.
Right.
Then.
It's really all three.
Let's go to factor number 2.
Yep.
Commercial real estate dive bombing.
Yeah.
My initial first thought is, who cares? Because there's not the significant trickle-down effect with commercial real estate that there is with residential real estate. Because, like you said, the Seattle guy that owns the 7 properties here in receivership, do you know who cares in Seattle? Only him. No one else cares. And there will be corporate raiders that come in and buy those buildings up for super cheap, which is what always happens. Right. And they'll sort of reset they'll reset the floor. The banks.
There's a part where it gets big enough, it becomes systemic problems that has its legs get into everything. Because there's also argument that back when the subprime meltdown, that the only impact it should have done to values is the percentage of people who had properties that had in default, but it affected the market so much. Because it's not just the properties themselves, it's also the banking system that supports them being able to service it, them needing stimulus, right? And so when the region,
what you don't have though in this particular circumstance though is everybody and their brother being able to buy 5 homes. Mm-hmm. Like you don't have a whole reset of the residential market. There are still going to be plenty of people out there to buy a house.
Right, but what happens is it starts to trickle into other things, because then the businesses and the banks that support them start to tighten up and they start to lose money, and then we start to see the job losses, and then it starts to just domino.
How? How is it the same?
Because we're all dealing with the same banks.
But it's a form. The factor here that we're talking about, the level of default is so much smaller than it was.
It's growing.
Yeah, but it can't. It's not going to reach. It's not going to reach millions of households. Like what was tricky here's what also happened that was tricky, right? In 2008, 2009, everybody did ARMs. They all started resetting super high, right? And so no one could afford to pay their mortgages anymore because they were all lying about how much money they were making,
right?
And they were all jacking up the purchase prices. Everybody was pulling everything that they could out of their house to go buy more houses and all kinds of other craziness.
But a version of the same thing's happening within the commercial real estate market, and it does impact the banks that lend the money, which does impact everyone who banks with the banks, which does impact everyone who gives money to them also.
I believe you.
It's not as impactful as what happened to subprime meltdown, but it is big. And so this is one of the reasons why I've said I've known about this stuff for over a year, and none of these things by themselves made me feel like it was going to be a reason for rates to come down for the things that you're saying.
Yeah.
But what we are talking about is does the sum of both, if we need to solve the problem, right? If we said, okay, how big, is factor number 2 going to be enough that they would want to cost stimulus alone? No. But if they need to refinance $9.2 trillion in debt anyways, and the solution for how to do it is lower rates, which also helps shelter losses in the second category, and the third category, which is, there's no buyers for the mortgage bonds, and the easiest way to make them more attractive is basically take the Federal Reserve and make them the biggest buyer of the bonds. You could basically say one event can solve all 3.
Yeah. I think the third
and they know how to do it.
Yeah.
It's also a tool in their tool belt. It's tried and tested before. And so if we want to solve all 3, an easy solution is stimulus. If stimulus money comes in, it lowers the rates. They can refinance $9.2 trillion in debt. It will salvage some of the losses in the commercial department, in the commercial space, and it will reattach some attraction to the bond market. It does all 3 at the same time.
Yeah.
And remember, they are used to just like controlling short-term rates, the Fed only has a couple tools in their tool belt. They could control short-term rates, and they could be the buyers of these bonds in the form of stimulus. They don't have, they're more likely to use something that they've used before than something that they've never used before. And since one of their blunt tools to curb inflation is to raise short-term rates, and one of their blunt tools to cause stimulus is to buy long-term bonds in the form of quantitative easing. And so it just says, if we have all 3 of these things that we have to address, that all together could cause some huge problems, and we have to care for what happens there, why don't we just use one of our tools in our tool belt to fix it? It could be that I actually think, and I would need someone else to tell me whether I'm wrong in this statement, is I think they do need to still control inflation, but I think that the problem with long-term debts and the bond market is a big deal, and I think that they probably should do some bond stimulus, but not necessarily lower the short-term rates as aggressively as what some people think. Instead of dropping the short-term rates 3%, maybe drop it 1.5 this year, but then be aggressive with the bond stimulus, because that will help fix the commercial real estate. It will help add attraction to the bonds, so because they're already having to buy the things anyways.
Yeah.
Right? Because the auctions, there's no other buyers, and just get the short-term rates low enough that the federal government can refinance that $9.2 trillion in debt. But I don't think it should be an even just drop short-term rates. I think that if it's really a discussion of what are they doing with short-term rates and what are they going to do if they're going to be a buyer of bonds. And I feel like it needs to be a blend of the two. But it's the first time I've looked at it and say, okay, just imagine myself in the Fed's chair seat, right? If these things are things that could affect the equity markets and the job market, and the deadline for these are coming up, and I only have a couple of tools in my tool belt, why wouldn't I use them? And so,
yeah, I think 1 and 3 are pretty. I guess I would say they make sense. Number 2, I'm still not buying number 2 because
I will say this though, I didn't believe for a second that either of the first 2 were guarantees to drop like residential real estate mortgage rates until the third one happened. I've been fully aware of the 9.2 trillion debt. I've been fully aware of the commercial property defaults, and I agree that neither one of those by themselves was enough for them to trigger anything. But the lack of attraction towards the bonds, and they already have to buy those things anyways.
Well,
what will happen is if they don't continue to buy bonds, like they're buying just enough to keep rates where they're at. But when they do that, right, it makes the rest of the market say, we don't want them still. You buy them, we don't want them. They need to buy them at an aggressive enough rate that other people will actually step in and start to take big chunks of what they were doing. Yeah. Now, what I can imagine what would happen is a lot of the lost desirability buying the bonds came because the governments that used to buy them are saving that money because they don't want to invest in the U.S. anymore when they have these trade war issues, right? What I think is more likely to happen is because really a lot of these deadlines are looming not far away. But I don't think that there's going to be a shift in rates initially. What I think is going to happen is this is going to be like red alert, high alert, wrap up some of these negotiations.
Correct.
So then some of these governments are not so anti-U.S. buying bonds, get them a little bit off of that position. And if they can't come in, if the bond market's still broken and they're still not willing to buy the bonds at that point, but that part has been removed, and now the other 2 issues together are putting pressure. And the Fed says, well, we've already been buying them anyway, so we need to do enough to like get people to buy them to make them attractive. Yeah. Then here comes a stimulus, and then here comes rates coming down.
Yeah.
To what rate? I don't know, but I think when I think about like consumer confidence and consumer awareness of the market, I have a pretty good pulse in because I talk to consumers all the time, right? And I know where their mind starts to shift. And we've been floating in 6s for a while, and the difference from 6.875 to 6.125 is a full 0.75%. And people will be like, that's a pretty big change. But in their head, when it goes from 6.125 to 5.875, they're like, whoa, we're in the 5s again. Right. And that's only a 0.25% change. So I do think that I've historically seen people get more emotionally when they react to when they see the first number shift. And so I think that if it gets to the point where we need enough that it will, not only enough that will make people feel good about rates are low enough to kind of support buying real estate again. Also, I think what's going to happen is we need to get the rates low enough that the investors who own these properties, when they're working with the banks in receivership, can split the difference. Like, okay, I'll put some money in, right? I see what's going on, but going from 3% to 6% is just too big of a swing. If we can get this into high 4s to low 5s, and we could split the difference and make some principal contribution on those loans to prevent some of the defaults. Some will default, some won't. And we also need the rates low enough that the government can service that $9.2 trillion in debt.
The problem with the commercial real estate is that it's not just the reset of the interest rates that are the problem. You have a bunch of empty office buildings.
Yeah.
This is the other problem.
That is the other problem.
The interest rates, while it may help a little bit, is not going to, I don't think, get you all the way there.
Yeah.
Because you're going to reset the value on these buildings significantly.
This is the world of value-added real estate, right?
But this is where
value-added real estate comes with opportunities. So during
always
COVID,
with commercial real estate, though, this circle of life,
right,
always happens.
But you just have to make sure that the corrections are manageable. And I think that because there's 2 things happening: the higher rates plus also the hybrid work from home and office vacancies. It's that blend that makes it a little bit more scary, right?
It makes the building less attractive. You used to just wait until somebody mismanaged their money.
Let's just take a little bit of a 5-year history of commercial real estate, because during COVID, a lot of commercial real estate was getting hammered, even with rates being low, because of purpose. Like, it's interesting. Yeah. People started traveling a lot. Airbnbs went on fire during COVID, but the first reaction is no one's traveling. All Airbnb bookings got canceled. All hotel bookings got canceled. And so, but then people need a place to live still, right? In the first pivot, and I thought I heard about this very early on, It's funny because I started hearing people when it starts to hit like mass scale, where people say, "I'm going to teach a class on how to do this." Is always one like old news guys.
Yeah.
But the first shift was a lot of people they looked for commercial real estate that were like hotels, and looked at what would it take, like which ones are zoned in a way they could be repurposed into multifamily. And then they could take the plumbing and electrical in these rooms, maybe combine 2 rooms into an apartment, and then, basically get a multifamily building for a discount. They'd have to renovate and convert it. But that was like a big shift that happened, like, in the middle of COVID, people were taking like hotel conversions into multifamily. I mean, that's old news now, right?
Yep.
But there was an automatic, point of view that maybe we could do this with office buildings. And some people were successful in doing it, where they'd say, okay, multifamily still has some desirability, the office buildings don't, let's do some conversions. And it's not enough to save that industry, but there's been some. But even yesterday, I was talking to a friend of mine, and some of the people are looking at stuff where they say, repurposing an existing building in multifamily is tough because, it's built for one purpose. It wasn't built for the other. So the conversion can be really expensive.
The plumbing, period.
Right. Just all of it's different.
Yep.
So sometimes it's just better to just level it. And so some of the buyers for the office buildings that we're seeing today are actually just, what they're going through is the feasibility to just scrape it, but then repurpose the land into something else, like into like townhomes and stuff. Mm-hmm. And so that's beginning to happen. So a mixture of those two things will help shelter some of it.
Yeah.
When there's always a loss, there's always a gain in some other category. Yeah. And so there's going to be smart people to look for those kind of conversions, which is why I've always operated as value add space. Like, where can something get repurposed into a better value under current market conditions? Yeah. And then you can always make a spread on that margin. And so, no, I don't think commercial real estate by itself is enough to incentivize stimulus, but it is a factor.
Yeah.
So is the 9.2 trillion. The 9.2 trillion in debt, I think, was a bigger factor. If I were to kind of rank in order, I would say I can't tell which one is higher: the 9.2 trillion debt, or the fact that the bond market's completely broken right now, and that the Fed had to buy bonds just to successfully finish the auction. But those definitely rank, in my opinion, the top two factors.
I think the bond activity, though, is a real reflection on all these tariffs and stuff.
It definitely is a major factor.
It could self-correct, I think, relatively quickly. But
I don't think it's going to go back to where it was. What we've learned about all things is that, like, if it was this and then it became that, it's going to end up being somewhere in between. Kind of like the whole, like,
But here's the other thing, though, too. One thing affects another, right? So if these things get worked out and there's enough certainty, right? And if they get worked out in any way like we would like them to, there will be a significant increase in money flowing in to the country with all these taxes, basically all these tariffs on these goods, which will help to reduce this debt, which will then make it more attractive to buy the bonds, which could create a different kind of a circle in some ways. It's really hard to know. Okay, let me ask you this, though. I'm going to pin you down.
Okay.
What is your prediction? And we need to set a calendar and revisit this sometime, just for fun.
My prediction is that somewhere between 9 to 18 months, the Federal Reserve will get a lot more loose. My real window is 6 to 18 months, but I think it's going to take longer than that. But my timing is never perfect. But somewhere, I think, up to but not exceeding 18 months. If the Federal Reserve keeps buying bonds, they're going to, it's like I said, that slippery slope, they've already started it. I think that they're going to end up having to step up and do some heavy stimulus that will automatically just bring down long-term rates with it. And we will start to see mortgage rates back into the 5s.
Okay.
That's my prediction.
I think I like your analysis.
It took me, to me, it's not one of those things alone. I mean, everyone needs to address all of them, but I've watched how the Fed operates, and like I said, they have a tool belt of a handful of tools, not a lot. They don't have a lot of things at their disposal to move. They can move short-term rates, they can buy bonds, right? And that's pretty much it. There's not a lot to them other than those two things. And so if it's their job to control those, usually it's just the one tool. The quantitative easing was never meant to be a tool to use again and again, which is one of the reasons why they've been so we are not in the market of buying bonds, right? That's why they tried so hard to break that connection, because that connection was made in 2008 to save the housing market, the quantitative easing, which I agree with that decision at the time. It reminds me a lot of like the trade wars we've had with the tariffs, where it's like, Trump wasn't the first one to talk about tariffs. Nancy Pelosi actually talked about it. Bill Clinton talked about it, and President Obama talked about it too. So traditionally, it's actually been more of a Democratic policy to try to make sure the trade wars were even.
Yeah.
And so to me, it's one of those things where it's like, if you let things go too long, the more painful it is to correct. And the more likely it is that the way you thought you could correct it isn't going to work out the way you wanted to, because you became too dependent on it. And I can see that being the case here. Like, we wanted to get away from quantitative easing being a thing.
Yeah.
But look, it's like subprime meltdown, quantitative easing. Think we're going to back off? The EU and Greece, remember that? 2012-13 started to fail.
Yeah,
Here comes more. Then he ramped up the bond purchases again, right? Because that was tanking the whole market. Then they started to back off again. 2018 rates are going up a little bit. Then COVID comes, right? And there's another event that happened around 2018 that pushed rates back down again. So then the Fed comes back buying it. Then they're trying to plan again. And we're talking about, at this point, we're heading into COVID, and stimulus had been around for over 12 years. 12 years. And then, in hopes they could eventually wean themselves off it again, comes like quantitative easing. Because, a lot of the ways they addressed COVID was very much, we've seen this before with the subprime meltdown, so let's get ahead of it. Right? So, back when the subprime meltdown happened, they had all these programs to help people that went to default. But the servicers weren't easy about it. So in 2020, they're like, you guys got to be easy with these people. You got to give them their forbearances, let them skip payments, and don't ruin their credit, right? Otherwise, we could have another whatever.
Well, yes.
And then here's a whole bunch of stimulus to push rates down.
Right. It wasn't exactly the same.
From the point of view of a mortgage banker,
Well, the whole world stopped. And so...
Yes, but the tools at their disposal to fix it were, like, they learned their lesson. And they said, okay, let's do the quantitative easing. That worked. We tried to give some programs to help people if they're in default. We didn't do a very good job of it, so let's do a better job of it this time.
Well, it wasn't even a program. It was like, just don't pay your mortgage and you're good.
It was a program. There were rules.
Oh, kind of. The
there
rule
were
was
rules.
just stop paying.
If they're agency-backed loans, they gave them 12 months.
Right.
Yeah.
Which is just basically blanket everybody. You're good. Stop.
But they had to make it easy, because last time they didn't make it easy and no one got the stuff approved. Well, people still went to defaults.
They also had to make it easy because everybody was freaked out.
Yeah.
And they needed to be able to just say very simply, this is what.
So here comes the next round of stimulus, and the stimulus was even more aggressive than the previous ones, because when they tried to tether the line in 2008, they didn't do it with quantitative easing when it came to rates, but they did when it came to the servicers. So it was like, okay, let's do both aggressively, which only meant they put themselves further into debt.
Right.
And then once they said, okay, the markets are good, COVID's done, and everyone feels good, now we got to take away the crack lollipop from the crack baby, right? And it's hard. It's hard, right? And so I understand their position of trying to fight, stimulating, and I don't love the fact that I'm making this prediction, because this is our, we got to leave a future for our kids, and we can't seem to find a way to get off the crack pipe, right?
Well,
of low rates and stimulus, but it's hard to project. Before, it was hard for me to project why they would step in to push rates down, or why there'd be any factors that push rates down. Now I'm starting to see an angle where it's hard for them not to, because of the mixture of all of these things.
Well, they're always chasing sort of short-term benefits and or putting Band-Aids on
long-term problems
that have long-term solutions and not short-term solutions. It's like,
tough to be
you can't eat a piece of cake every day,
But if you have been for the last 4 years,
right,
it's gonna be that harder to break that habit than if you'd only done it for 4 days. Yeah,
that's right.
Yeah,
and so then they're like, "Oh, I'm just gonna do a tummy tuck and keep eating some cake." You're like, "Well, that's fine, but you're gonna be,
you're still gonna get
another
diabetes.
5 years. You're gonna have a problem again."
Yeah,
Yeah.
So,
all right, cool. I like that. I think that's a good prediction. We'll have to revisit it. What do they do the rates on like a certain day of the month? Is it like the beginning of every month?
There's a Fed meeting scheduled every single month, right? And then there's T-bill auctions scheduled also. So
we'll have to just peek in on a monthly basis and see what's happening.
But I think that I actually think that the moving of short-term rates, if they just move it, isn't actually what we need to be paying most attention to. What we want to hear is, when they have the next Fed meeting, they're going to have to explain, because Jerome Powell does a little announcement every single time they do that meeting,
and it's highly scrutinized.
highly scrutinized.
Like every word.
And so he's going to get scrutinized for the fact that the Fed had purchased bonds.
Right.
And so we're going to find out whether or not my like peeking over the fence is what's brewing in his head, because now he's meeting with the government.
Yeah.
Now he's getting all these pressures. And now if he just says, okay, I know you guys are real estate guys trying to give you lower rates so you can, pad your pocketbooks. But then it becomes like, oh, shit. Like there's actually some valid points here.
Right.
And I already had to step in to save. Because if no one would buy the rest of those bonds the way that they did, rates would have shot up.
Right.
A lot.
Well, that money funds the government's like daily activities, from what I understand. The T-bills, that's like payroll.
Yeah.
Things like that.
It's
like,
a method of them getting liquidation.
Right. It's liquidity.
Yes.
That's what I meant to say. Like, they need that money. Like they actually use it.
Yes.
It's a function of the government.
Yeah. They that's why I said that slippery slope
Yeah.
of them buying the bonds already began. And if they didn't participate in it, we would have seen, maybe 1.5% rate increases across the board on long-term bonds, including like mortgage rates.
Right.
Like what
you just bump them up basically until somebody will buy them, right?
Forget about how much, remember I mentioned the commercial real estate issue? How much worse is that problem if rates go up 2%?
Right.
And then the little bit of appreciation we are getting in residential real estate, what happens when that shoots back up to 8?
Right.
Now it's like, okay, if residential real estate goes up to 8 and commercial rates go up to 8, now that what was already a bad problem becomes way worse. The one that was kind of doing okay starts to go the other direction, and it makes it that much harder. Now the $9.2 trillion debt is that much worse. Right. There was no option. Them buying some of those bonds was absolutely mandatory.
Yeah.
And if the other issues still have to be addressed, they could just choose to keep buying in minimal amounts to just keep it where it's at. But it's hard to, if they're going to be buying them, you might as well try to fix all the problems and then see if you can wean back off of it later on.
Yeah. All right. Well, we'll see. Remind me when this comes out so I can do some research before.
Very interested to see how the future auctions go and what Jerome Powell says in the next meeting. We'll see though.
Okay. All right, cool. Let's wrap this one up. That was cool. That was good. Good discussion. This is another episode of the Business Barbershop Podcast. I'm Chris.
This is Keen.
See ya.
See you guys later.